All right. So to retake on our afternoon, let me introduce you our next speaker. His name is Shaun Usmar from Xstrata Nickel. He's Vice President and Chief Financial Officer. The title of his presentation is The Global Financial Crisis as a Business Opportunity, Reflections on Xstrata Nickel's Approach and Outcomes. Shaun Usmar was appointed CFO of Xstrata Nickel in August 2006 and is based out of Toronto, Canada. He is responsible for all financial aspects of the corporation's operations and projects and is accountable for the strategy, marketing and sales, business development, risk, procurement, IT, and legal functions for the global business. Shaun joined Xstrata plc in London in 2002, following the company's listing on the London Stock Exchange. His senior-level management experience within the company includes more than 2 years as General Manager, Group Business Development for the Xstrata Group in London, Chairman of Xstrata Technology, and 2 years as CFO of Xstrata Alloys in South Africa. Prior to joining Xstrata, Shaun gained invaluable experience as founder and investment principal at BHP Billiton Corporate Venturing Group and at Billiton plc as corporate finance manager, where he was involved in the financial evaluation and the structuring of projects and investment opportunities in jurisdictions like Colombia, China, Australia, and South Africa, as well as actively participating in the BHP Billiton merger in areas such as financial valuation, financial due diligence, risk management, and post-merger integration. Shaun also gained experience as production engineer at mining and metals companies Bayside Aluminum and Iscor Limited, and has served in the South African Air Force as technical officer. Fluent in English and Afrikaans, Shaun holds a Bachelor's of Science in Engineering degree, Metallurgy and Materials from the University of Witwatersrand in South Africa, 1991, and an MBA from J.L. Kellogg Graduate School in the U.S., 1999, graduating with distinction from both institutions. Please, let's welcome Shaun.
Thanks very much. Got to shorten that bio. The topic today is really picking up on the same themes as the previous speaker. Given what's happening in Europe and the US at the moment, I'm hoping this is purely academic and of completely no relevance at all to what we're facing. But I'm going to share with you nonetheless what happened to us in 2008, 2009. And really some of the outcomes that we found in our business. I'm actually starting this presentation with this perspective, which really reflects some of the market balance of the nickel space and the nickel price movement over time. The main reason is it's there for context. It goes back to 1980. You've seen it from our prior speaker's perspective, perhaps over a shorter time frame. But the reason this is important is, I think all too often, within our businesses, we often don't take the time to put our heads up and reflect on the environment that we're actually dealing with, to be aware of certainly what has happened in recent times, and to certainly try and learn from history. And to give you a bit of context, you don't need to look too hard to see, of course, there are economic cycles that influence this sector like any other commodity. It's also extremely volatile. In fact, the most volatile of the primary commodities that's in Xstrata's portfolio. It's more niche, it's quite high value, but it is characterized by substantial volatility. And if you look at, more recently, we did the takeover of Falconbridge in August 2006. They say timing's everything. We had the benefit of some heady times in late 2006 through 2007, with nickel shooting up to joyous levels of $25 a pound, certainly in mid-2007. But of course, what goes up comes down, and with the depths of the financial crisis, we plummeted to about $4 in a very, very short period of time. This context is important in that the business we inherited had some amazingly competent and very good people in very different areas, but it was a very centralized business model. Xstrata's business model is very devolved. Our office, which we established, our corporate nickel office in Toronto, has 50 people. We try and put the capability in the sites and in the businesses where the better decisions are hopefully made, but we try and get people to work together and to be as effective as a team as they can be. It takes time, though, to try and achieve that. And I think the overriding thing I want you to focus on when you think back to this is that early journey. It's quite hard to facilitate change when things are going extremely well, when you're making a ton of money. And that year, 2007, we made about just over $2.5 billion of EBITDA in the business. Trying to get people to be focused on value creation and be prudent is a little tougher in that sort of business environment. Ambition reigns. So just the last bit on scene sketching. This is a presentation we made to some analysts in September 30th, 2008, around the time when things started going a little pear-shaped. You'll see that the pipeline at the time on our capital growth was about $11 billion. As a team, it was a substantial part of Xstrata's larger portfolio at the time. And I'd say as a team, it was quite clear to us that the plans all had robust execution, or certainly business plans that underpinned them, but they were vulnerable to, in some cases, environments which dropped down or would decline, a recession. And it didn't take great foresight, and I can't claim any of us saw the financial crisis coming. That would be a lie. But it was clear as a management team, we had to start thinking that the world may not turn out as robustly as it seemed to be at that point in time. So in order to do that, we started going from probably a more hierarchical form of engagement, looking at certainly our strategic discussions as a business, exclusive club of vice presidents, made that as engaging and as broad as we possibly could. We started trying to get people on our strategy in early 2008, even late 2007, to start focusing on just scenario analysis, high-level scenario analysis. What if? What happens if the world doesn't quite turn out as robustly? What happens if resource nationalism rears its head, as we've seen in Australia and elsewhere? What if? So just trying to challenge some of the thinking of a lot of the team members that were there. So fast forward, I think it turns out that was quite fortuitous. The work we did in 2007, 2008, putting decent information platforms in, trying to instill a slightly more participative, more holistic view of the environment we're competing in, understanding the industry we're competing in, who our competitors are, our relative strengths and weaknesses, and ensuring that people, regardless of whether they had a good technical or financial or other background, were part of that conversation, so we could be as holistic as an organization as we could be. When the financial crisis certainly came about, I think armed with that, we realized that just after Lehman's happened, there was clearly a lot of panic in the market, a lot of negative sentiment. My chief executive and myself got together on a weekend, and we said, look, we know that we have to act and lead by example. We spent that weekend really working through some of the things that we thought we needed to do as an initial demonstration of conviction for the change that needed to happen. The consequence of that, and in keeping with those of you who I can see in the audience who I know have been through perhaps a takeover or an integration exercise with Xstrata, and I know there are a few, it was done in a very similar method. Swift, within a 30-day period effectively, we started off and we said, if we're going to initiate change and drive home the importance of this in our organization, we can't just delegate to the sites and say, well, get back to us when you've done it. We had to make a statement up front. And so we started with the Toronto office. We started with the senior management team. We removed the most senior layer of management at the time. We made sure that the decision-making, particularly in a time of crisis like that, was a lot more direct and a lot more immediate. So effectively, there were a number of what was chief operating officers that were removed in that process. Our Toronto office was shrunk down by about 20%, and considering it's 50 people, give or take, including IT, finance, some of the sustainable development, admin support, and things of that nature, It's not big, but it was important to start with that. So within 30 days, the uncertainty was out of the way. We then went through what was effectively 6 rounds of business planning and budgeting with our sites. Some of it prescriptive in terms of the financial and other indicators we knew we had to see. But the idea was not to have a top-down approach to trying to tell people about their businesses. It was really almost a Socratic approach, trying to get the sites to think critically on the interdependencies and to work together to ensure that we could actually make longer-term value-accretive decisions, and certainly not sub-optimize the business, as I think can be the tendency at times, but also to provide them with the information to make decisions which they perhaps otherwise couldn't see. It was 6 rounds because it was necessary. It wasn't a prescriptive process, but we had to ask the tough questions and get people to go away and come back, and then not only understand the changes that needed to happen, but to make those happen. And I think therein lies, with the benefit of hindsight, some of the success that the team enjoyed over that time. There were some tough choices that were made. At a time when nickel was still $10 a pound, saying, what do you think would need to happen if nickel fell to $4? Denial was the first thing. People would say, well, clearly it won't happen. We're not going to get to those levels. It's comfortable. And we're saying, I understand. It may be unlikely. But what would you do in those circumstances? And what it meant is, when it happened, we were somewhat mentally prepared to be able to deal with this. So looking forward, the consequence of that is that after the Toronto restructuring and some of the changes in the business planning that took place with the various sites, we initiated very rapidly. We took given the volatility in this sector, the understanding that if you want to be competitive, you need to either be robust and certainly in the lower half of the cost curve in such a volatile sector, or you have to be extremely flexible and nimble if you're at the top part. And that's not that easy. Just your social license to operate alone makes it very hard. Falcondo, our operation in the Dominican, is highly dependent on oil and electricity generation. It was a fourth quartile producer. We took that down. That team kept a substantial core, several hundred people, in order to maintain that business and get it ready for the spring, I think, as the previous speaker described it, where we knew that we would bring that back. But it made no sense to literally pay dollars a pound away to customer base to take a non-renewable resource and ship it off and exacerbate a supply situation or a supply overhang. They took a bold decision. They put the things in place in order to improve their asset and to actually bolster the impact or dampen the impact on their local communities by investing more in corporate social investment over that time. So I think that was a first key move. Sudbury, Mark Boissonneau, the vice president there, I think had been in place all of 2 weeks when Lehman's collapsed. And so trial by fire, showed a huge amount of courage with the new team and effectively took down some of the older assets near end of life of mine. They may seem obvious now with the benefit of hindsight, but because of the information systems previously, it wasn't necessarily obvious. There was some cross-subsidization between sites and things which was taking place in a very complex metallurgical and mining complex like Sudbury. The team understood that, worked through it, made some tough choices, took down a couple of mines, restructured centrally, and continued to focus on investing in the future of that business, namely Nickel Rim South, which today is a cornerstone for our business. It was delivered on time, slightly under budget, and is a substantial negative cash cost producer for our business. So again, some substantial, tough, short-term decisions, but moving forward, focusing on really the future prosperity of that business. We continue to focus on things like procurement in our business, opportunities to do that more effectively, work with our suppliers to improve our cost positions. And if you have a look, the combination of all of these things is, real cost savings in the heady days were $20-odd million, 2007, 2008. The last 2 years, it's gone up to over $200 million as a consequence of some of the actions taken. And I think importantly, if you look at the production over that period, we've actually, through debottlenecking and low capital intensive investment in our metallurgical assets, we've actually continued to hit record production through those facilities. Our mine production went up over that period in our sulfide integrated nickel business. We've discovered new polymetallic ore bodies You can see the impact in 2010 of nickel rim coming on successfully. And importantly, our operating cash flow and our EBITDA has reflected some of the actions that were taken at that time. So what does it mean? Just for context, that's where we were around the time of the financial crisis, third quartile. Certainly a lot of plans, but importantly, if you look at where we've resulted now, lower second quartile, that is not a position that has been attained through buying our way down the cost curve. It's not a case of throwing billions of dollars in order to have a lower C1 cost. And you can see that certainly in the sulfide business at nearly $5 a pound before. Last year was $2.16. In fact, we're on track for lower than those levels in our business this year, and I think remain in a very robust position. Just one other point here. Besides focusing on our cornerstone future growth options like nickel rim, like Koniambo, the more leveraged opportunities. This point again, if you are in a volatile sector, if you're in the lowest quartile, by all means, that's a good place to be. Lowest 2 quartiles, that's pretty easy to make those sorts of decisions. But if you're more leveraged, how do you ensure that you can come back and be more competitive? We took down a number of certainly more leveraged growth projects at that time. The teams then worked on them, restructured them, have put them back in the minute the economy improved, have brought them back, and are in a far more robust position now with the benefit of that restructuring than we otherwise would have been. And I think just mentally what it did for the management team in terms of flexibility and how they see the world made a profound difference to us. So we saw that across the board in Australia and in Sudbury. We saw that pretty much in all our management teams. So just more indicators of what happened. Our expansionary capital, we'd spent quite a lot of money on sustaining capex and expansionary just after the takeover. Some of our locations, like in northern Quebec, up in the Canadian subarctic, they're tough jurisdictions. You don't just build something and then leave it. You have to continue to sustain. And so we had some catch-up capital to spend there. But certainly by the time we got to the financial crisis, a lot of that had been spent. We were able to focus very strongly on cash generation in the business, and you can see that reflected in lower sustaining capital levels. But again, while we also were able to increase capacity in our base business, debottleneck and move forward. The other thing is, the minute things started to improve, we were able to in turn focus on a value creative basis on other opportunities. And those in Quebec would have seen recently, I think we've announced things like just over $500 million expansion for our Raglan mine over the next several years in order to take that operation from 26,000 tons to over 40,000 tons and take it down to a strong second quartile cost position. So again, retaining the optionality. The expansionary capital, the bulk of that really is Koniambo, and making sure that, one, we use the opportunity at the time of the crisis to make sure we could get some of the skills that were hard to come by in more rampant times in the market. But secondly, to make sure that we could actually look critically at some of the contracts that we had and to see what we could do to control cost inflation. Things have recovered. I mean, the cost inflation has been difficult, and we've actually seen substantial increases certainly since the financial crisis. But that really was an opportunity we seized at the time. And I think just an important thing, if you look forward, the capital intensity post-Koniambo for our business is extremely low. And I'll touch on that a little later in terms of the business. But I think importantly, we kept our optionality. We focused on the low-cost, robust part of the business. And importantly, we engaged as much of the organization as we could in understanding the things that needed to happen, because the people on the ground ultimately are the ones who deliver the results. This is just hopefully a reasonable view of what's happened, not just in that period. And you can see that big decline in cash costs, including the ferronickel part of the business, Falcondo coming off and being restructured, continued increase in our sulfide business in that period. You'll see we're still going to increase by over 30% in our sulfide business over the next 5 years or so. And our business as a whole is set to more than double in the next 4 to 5 years with Koniambo and the increase in Falcondo over that same period. We don't project it on these screens, but we are looking at a cash cost which will sustain certainly in a lower second quartile cash cost position, which has been important to us. Again, the context of the environment we compete in hasn't changed. We're not looking to throw money through capital in order to sustain it there, but the quality of our portfolio, the life of these assets, enables us to maintain a reasonably low capital future and a very competitive position. And in fact, each of the sites, the brownfield sites we have, all have their own growth options, some higher cost than others, but the sites are aware of them, and those will be used as the market opportunities allow. So just to provide the context, this is a snapshot, not just of the different parts of the business we have around the globe. The sulfide business in particular is very integrated. From the time we dig something out in the Canadian subarctic or in Australia, it's been through Sudbury, through the smelter, and then finally turns into a refined product in Norway, typically about 8 months. Substantial amount of working capital and a lot of resources and talent along the way. The ferronickel assets, you can see Falcondo and Koniambo due to come online in the second half of next year. You'll see in 2011, at the moment, we're very close to BHP as the 5th largest refined nickel producer. Once we've finished those plans you saw in the previous, we should be about 3rd, just behind Valais and Norilsk. My last slide. And I just wanted to end on Koniambo. You know, the focus again for us is you need to, I think it was Obama in happier days who said, never let a good crisis go to waste. And I think a lot of the politicians around the globe, if you look at them now, perhaps have. They've failed to find the leadership and the unity. It's perhaps easier with a benign dictatorship like a business. But, you know, you look ahead, we've been able to, I think, make some substantial and necessary changes at a time where it was possible to do it. And we were able to do it quite quickly. I think if we had done it slowly, we would have missed that window of opportunity. But in the meantime, we've been able to channel these resources into what is going to be the future growth of this organization while engaging and actually raising the possibility and awareness and the engagement amongst the base of our business. And that's just an image of Koniambo. We are burning about $100 million a month on that project right now and are on track for second half of next year in order to be able to produce that. And that will be lower second quartile cash cost position. So regardless, hopefully, of whatever the world has to throw at us, I think we're in a pretty robust position. So look, that's all I wanted to share with you today. If there are any questions, happy to answer them. And if not, thank you for your time.
I think we have time for one question, if there's any.
It's a great question. So there's a couple of things, because we get this a lot of questions around this with a very regional focus. There are not too many more metallurgical facilities being permitted and built around the world. You need a level of economies of scale in order to make these things competitive. And if you look at the copper sector as an example, a lot of these smelting and downstream refining facilities just simply can't compete with the likes of China. We have know-how in Norway that spans over 100 years. We have environmentally friendly green power. It's hydro, very low cost. And frankly, you don't have the luxury with a resource base in northern Quebec and the subarctic conditions to go and stick things close to mine mouth, which would be ideal. It just simply isn't the throughput. And the irony is, when we look at our business on an integrated basis, we're one of the largest recyclers of nickel and cobalt products in the world through our metallurgical facilities. We have the ability and the flexibility in what is quite an illiquid market to be able to take these things from around the world, process them, and make them competitive. You would not be able to sustain this as much as we would like to on a regional basis. You wouldn't get the investment, you probably wouldn't get the permitting, it wouldn't make business sense in order to do so.
Thanks, Shaun. Thank you.